Recently, China made headlines by devaluing its currency, the yuan. But what exactly does that mean? And how will it affect the USA and the rest of the world? Let's break it down. A devaluation means that the value of China's yuan has decreased compared to other major currencies, like the US dollar. This is a move that can affect international trade, investments, and global markets. Currency devaluation occurs when a country's central bank lowers the value of its currency in relation to others. This can be done intentionally by the government or through market forces. China's government controls the value of the yuan by managing its exchange rates. By devaluing the yuan, China can make its exports cheaper for foreign buyers, which can help boost their economy, especially when faced with slow domestic growth or trade tensions. The primary goal of devaluation is to make Chinese goods more attractive and affordable to the rest of the world, increasing their competitiveness in global markets. In the short term, the yuan's devaluation can boost economic growth, but over time, it may lead to higher costs for Chinese households, especially for imported goods and raw materials. What about the USA? The devaluation of the yuan can have significant implications for American businesses and consumers. For American companies that rely on manufacturing in China or importing Chinese goods, this can be a double-edged sword. On one hand, it makes Chinese exports cheaper for US consumers, potentially lowering prices of goods in stores. For example, electronics, clothing, and toys that are made in China could cost less for US consumers. But on the other hand, it could also affect the balance of trade between the US and China, leading to tensions and retaliation. If China's currency devaluation is seen as an unfair trade practice, it could trigger trade disputes or even tariffs, especially in an environment where the US is already engaged in a trade war with China. The yuan's devaluation could cause volatility in stock markets, as investors may fear global instability or more aggressive trade policies. Now, let's talk about how the rest of the world will feel the effects. Countries that depend on Chinese exports, like many in Europe and Southeast Asia, may benefit from cheaper Chinese goods, stimulating their economies. But it's not all positive. Developing countries that rely on importing Chinese goods may see inflation. If the yuan falls, their own currencies may also weaken against the dollar, which can raise the cost of imports and reduce purchasing power. Devaluation can also affect global commodities. Oil prices, which are often priced in dollars, could rise in countries whose currencies weaken against the dollar, causing a ripple effect in inflation. For emerging economies, a falling yuan can lead to capital outflows, as investors seek to protect their investments from currency risks. This could create instability in markets in countries that have strong ties to China. To sum it up, China's devaluation of the yuan is a strategic move to boost exports and improve economic growth. But it also has far-reaching consequences for the USA and the global economy. Whether it's cheaper goods for consumers, trade disputes with the US, or a ripple effect in global markets, the world will feel the impact and improve economic growth. But it also has far-reaching consequences for the USA and the global economy. Whether it's cheaper goods for consumers, trade disputes with the US, or a ripple effect in global markets, the world will feel the impact